In 2021, Bitcoin hit $63,000. One coin, one moment. Millions of wallets went digital overnight. But here's the catch. The total market cap, every Bitcoin combined, was bigger than the GDP of some countries. And yet, most people didn't own it. Most people were cheering someone else's gamble. Why did we all act like it was inevitable?
Let's rewind. 2009. A mysterious figure named Satoshi Nakamoto releases a white paper describing a peer-to-peer electronic cash system. No banks, no governments, just math. For some, this was freedom. For others, opportunity. Fast forward a decade and Bitcoin has spawned billion-dollar companies, venture funds, celebrity endorsements, and Wall Street products. Regulators shrug, the public fantasizes, and somewhere in between, every newcomer thinks, I can get rich too. Here's the cast. Miners with giant rigs sucking electricity, traders riding charts like roller coasters, VCs and hedge funds playing with other people's money, and the quiet army of retail investors, your neighbor, your cousin, maybe you, handing over cash to a digital ledger they barely understand. Bitcoin works like this, like you're 5. Step 1, imagine a giant notebook everyone can see but no one owns. That's the blockchain. Every transaction is a line in the notebook. Step 2, new coins are mined by solving puzzles. Think of it like a digital lottery, except the lottery costs billions in electricity. Step 3, the puzzles get harder as more coins exist. Scarcity is built into the system, like limited edition toys. Step 4, prices aren't set by stores, they're set by whispers, tweets, and debts. Supply is fixed, demand is everything. Step 5, the value? Purely collective belief. Bitcoin isn't money, it's a giant confidence game dressed as math. Visual, stacks of coins appear, then vanish when the puzzle's unsolved. That's the heartbeat of the system.
But here's the part they don't tell you. Hype fuels Bitcoin more than technology. Media loves it. Every moonshot headline is free advertising. Celebrities tweet and the price jumps. VCs buy in, Wall Street launches ETFs, politicians nod vaguely. FOMO spreads. Every late adopter feels stupid for not owning a piece. Here's the twist. Bitcoin miners are also selling. Every time the price jumps, they cash out. The same people who designed the system profit from the panic and excitement of newcomers. Now watch what happens. Social proof kicks in. Friends, coworkers, YouTube channels, all preaching the next big fortune. It's a self-reinforcing loop. Hype creates demand, demand inflates hype, and the system looks unstoppable. But here's the other part they don't tell you. The network is energy hungry. It's a carbon machine disguised as freedom. Every transaction burns electricity like a small country, and that's before we even touch the environmental and social costs hidden in supply chains.
Here's the rut. Step 1, volatility. Bitcoin can lose 30% in a day. Step 2, leverage. Every exchange offers margin, lending your money to someone else to play bigger bets. Step 3, fraud. Scams, exit schemes, fake wallets, and that's just the start. Twist 1, most people never own the coins themselves. They own claims on exchanges. If the exchange folds, your Bitcoin vanishes. Twist 2, mining centralization. While Bitcoin is supposed to be decentralized, 70% of mining power sits in a handful of corporations. The lottery isn't fair anymore. It's rigged. Twist 3, regulatory uncertainty. Governments can ban exchanges, impose taxes, freeze assets. And the biggest twist, the math itself doesn't guarantee profit. It guarantees only scarcity. Price depends entirely on faith, and faith can evaporate overnight. When the system wobbles, panic spreads like wildfire. Exchanges halt withdrawals, small investors see their life savings cut in half, families skip meals, some tech workers burn out on mining rigs running 24/7. Meanwhile, the early adopters, they cash out. Always. One vivid story. A retiree in Ohio poured $50,000 into Bitcoin in 2017. The price spiked. She borrowed against it to remodel her home. Then it crashed. The remodel loan stayed. The Bitcoin disappeared. Her retirement vanished. Zoom out, this isn't just about Bitcoin. It's about incentives. When risk is socialized and reward is privatized, the public pays the price for someone else's bet.
Today, new coins and tokens promise the same story. Crypto 2.0, DeFi, NFTs. The incentives haven't changed. The hype is louder. Retail investors are still human, still greedy, still vulnerable. Understanding Bitcoin isn't about hating tech. It's about seeing how belief and greed are monetized. Knowing the mechanics keeps you safe. Knowing the history keeps you ahead. Rule 1. If you don't understand the math, you're not in control. You're a spectator. Rule 2. Hype inflates value faster than any ledger can track. Don't get swept. Rule 3. Scarcity doesn't equal security. Limited supply is meaningless without stable demand. Rule 4. Look past the headlines. Profits are rarely shared equally. Rule 5. Incentives drive behavior, not ideals. Follow the money, always. Final moral sting. Bitcoin isn't a revolution. It's a mirror, showing how easily we can be sold a dream while someone else wakes up rich. Subscribe for the next story where we follow the money before it disappears. Again.